Hi, this is Jim Cunningham. I've got Shannon Behan with me from Ascent Wealth Management. Today, we're going to talk about taxes are going up, preparing for the expiration of the Tax Cuts and Jobs Act of 2017. That was the big tax bill that reduced a lot of taxes. And we're going to talk about what happened then, kind of what's been happening the last almost 10 years or so, and what to expect the day after December 31 of 2025, which is January 1, 2026. A lot of taxes are changing. A lot of the rules are changing and taxes are going up. So we're going to cover what the Tax Cuts and Jobs Act was. So this has been in the news a lot lately, as well as the provisions that are expiring December 31, 2025. Basically, your tax base is broadening, which means taxes are going up for more people. Reduced individual tax rates was what happened with the 2017 Tax and Cuts and Jobs Act. Those are going up. Business tax relief, that's going away. And then estate taxes are effectively going up. And we'll talk about how that works. And what does this mean if you own a business? So if you're a person who is not a W-2 earner, what does this mean? Essentially your taxes are going up in 2026. And then the proposed Biden fiscal year 2025 changes. Also, how to prepare for this. So there is a level of preparation that you can do. If you're watching this on YouTube, go ahead and hit subscribe to our YouTube channel. And then this pops up in your feed and gives a little thumbs up. That would be really helpful. You can also share this with other people who might be interested in it. I'm a partner at Cunningham Legal. I've been an attorney for 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust and probate law, real estate broker, securities and insurance licensed, and a pilot. And if you're watching this on YouTube, we have a whole bunch of lawyers here, about 13 lawyers, I think. And we are all focused on creation and passing of multi-generational wealth, estate planning, and real estate and those related business matters for family-owned businesses. I have today with me Shannon Behan. She is a partner at Ascent Wealth Management. Ascent Wealth Management is a financial advisory firm, and she's here because a lot of what we talk about necessarily involves this sort of three-legged stool, which is the attorney, the CPA, and the financial advisor. And Shannon is a certified financial planner and has a lot of experience in the financial advisory space and helps out a lot of our clients. Do you want to talk about, I will let you chime in here on the disclaimer, Shannon.
Yeah. So anything that we talk about today in terms of financial strategies or, specific options that could be available, they really depend so much on your specific financial situation. So while I might be talking high level, I'm not giving specific financial advice to anyone today. Likewise, we've got, a couple different entities that we're affiliated with where we hang our licenses. So this is disclosure about who each one of those entities is. But again, underlining that it's really important that you speak to someone specifically about your situation before making any decisions about any of the things that we talk about today.
And this is the legal disclaimer. There's no attorney-client relationship. When I say you, that's just to make it so you can understand. And a lot of this is making sure that you're the person listening to this or watching it. The whole point of this is to help you understand more about these complex subjects, because I don't think people talk enough about this. I know I can talk until I'm blue in the face about it, but Shannon, I think you and I know this stuff just isn't discussed enough. And it's really not even that well understood by many advisors. And we get this feedback because the advisors watch our videos. So what is the Tax Cuts and Jobs Act? Well, in 2017, Trump was elected in the fall of 2016, took office in 2017 in January. It took until December of 2017, even though there was a Republican House, Senate, and Republican in the White House, it took that long to get a tax act through. So this stuff takes a long time, even if you're the party, whether you're Republican or Democrat, if you control the various levers of government. Now, it was designed to simplify the tax system. That, to me, is just, Shannon, a complete joke, because all the smart kids know that if we really want tax reform, we have to sunset the Internal Revenue Code, sunset the Internal Revenue Service, and really start new. It's like you just need to obliterate the whole thing. It's just too many things are interconnected. You just need to put an end to it. The GDP, by the way, gross domestic product, which is the sum of all goods and services in the United States, went from 20 billion in 2018 to 26 billion in 2024. We had a little something in there called COVID in the middle. And by comparison, China, their GDP increased 4 billion. So whether this would have happened with or without it, it was designed to increase the economy. The economy did grow, and that's really part of, Shannon, what a lot of tax policy is about, is they're trying to accomplish economic and social goals through use of the tax code. And we'll see that in a little bit in the Biden proposal. So really big key component to this is the permanent lowering of the corporate tax. So this, if you have an S corporation or a partnership or some type of entity that does not pay corporate tax, right, then this isn't really helping. But if you're an Apple and NVIDIA or one of these big companies, that tax rate was lowered from 35 to 21%. Now, there are state income taxes on top of that as well, but this was a really big deal because 35, I think, was the highest in the developed world, wasn't it, Shannon, when the tax cut was cut? So this is a net positive. This is a permanent thing. This is not sunsetting. And the other thing is we got a doubling of the standard deduction. So this really helps if you're someone who does not have a mortgage, maybe you're renting, you're a high W-2 earner. This doubling of your standard deduction really did cut your overall taxes. However, if you do pay state income taxes, so SALT is the acronym, state and local tax, that used to not be capped, but now it is capped at $10,000 per taxpayer per year. And that's something that there have been states that do workarounds. We've covered that in other webinars. Certainly, if you're a business owner, there's a workaround in California, and there are workarounds in other states. So that's effectively not as much of a limitation as it might seem. But that cap or that limitation is going away in 2026. So a qualified business income for pass-through entities. So that's basically a 20% income tax deduction. If you're a business owner and your business generates $1 million a year in income, you're able to deduct or remove $200,000 in income and not pay federal tax on that. And that comes off your highest tax rate. So it's a very powerful tax savings tool. And I know, Shannon, when we work with business owners, because we work with them jointly, this is really a big deal for many business owners. Now, there are some exclusions, but to understand from a tax planning standpoint, from this sort of safe harbor, you want to make sure and pay your quarterlies. That's going away in 2026. So this is something you need to start being mindful of now, because there's some things that you can do perhaps, and we'll talk about this, but some ways to maybe accelerate some income in 2024 and also in 2025 and not pick that income up in 2026. So business owners have a little bit of flexibility sometimes on when to pick up income and when to not. And then there was a modification to the international tax rules. So you want to you want to cover this slide, Shannon? Tell me what's going on here.
Yeah, I mean, I think for me, when just at a high level, when I think about this, it's really the environment that we're in now, midway through 2024, is that there's just so much uncertainty, right? Because to your point, these tax reforms take a long time to implement, even if we get, a Republican president this fall, even if there is a push to extend those tax cuts, it could still take beyond this original sunset deadline in order for those things to be implemented. So we're in this weird kind of limbo situation where we've got a plan for something that we don't know for sure if it's going to happen or not. And so that also complicates some of these strategies that we're going to talk about today, because some of those things we can wait until right before the end of the potential sunset and get a little bit more clarity. But some of those things we've got to get those balls rolling now. So as we approach that end of 2025 deadline, when we see all of these changes coming into effect, we're going to have to also be mindful of how long it's going to take to implement any of the strategies that we're going to talk about today.
Yeah, and I think if you've not been asleep for the last couple of years, it's hard for the party in power, the Republicans, to even elect a speaker. And we went through several iterations of votes, and look, as we're talking real time, there's a lot of discussion about President Biden and his, whether or not he's the right candidate for the Democrats to run on the ticket. So a lot of uncertainty. And again, we're not picking sides. We're not trying to nudge people one way or another. We're just talking about the facts. And the reality is, to get Congress, the House and Senate, to agree and pass legislation that the president will sign can be a very tall order. Sometimes it's not, but sometimes it can be a very tall order. So I think when I talk to other advisors, Shannon, and you included other attorneys, CPAs, financial advisors, there are two camps of people. There's the camp of people that say, oh, certainly these will get extended, don't worry about it. There's the other camp of people that say, look, the law is expiring, and unless there's new legislation, this is what the law is. I'm in the camp of what the law is, which is it's expiring. So please pay attention to this. There are some things that you can do. But if you have a hopeful mindset, right, if you're would be a proponent of extending these tax breaks, that is a very uncertain outcome. A more certain outcome is what is slated to happen, right, in the law. So what is happening? So tax simplification and base broadening. So in 2017 and 2018, we had certain brackets for individual and joint filers. And what happened is the number of brackets shrunk, or that they were reduced. We had this pass-through business tax change. So if you're a business owner, so if you're the owner of an S Corp or a partnership or an LLC, and you have this pass-through income, you're able to deduct, unless you're a professional, lawyer, doctor, architect. I think architects were excluded from that because it's related to your financial advisor, whatever it is. You don't have some of these benefits if you make over a certain threshold of income. And then the big one, of course, is the estate tax relief. So what is expiring in 2025? The current death tax exemption, meaning the amount you can leave tax-free, is currently 13.61 million, probably going to be about 14 million next year. That is getting cut in half in 2026. So if you're single, that means you can leave 7 million tax-free. If you're married, you can double that to 14 million if you do some certain things that we'll talk about. And then also the tax rate itself is jumping from 40 to 45%. So everything above 7 million in 2026, taxed at 45%, due 9 months after the date of death. You want to talk about these income tax rates, Shannon?
Yeah, so on the left is what we had before the Tax Cuts and Jobs Act went into effect, and on the right is how they were modified. So immediately what we see is that highest income tax bracket was previously almost 40%, came down to 37. So that was one of the major changes. But then another big thing to point out, which is bolded here, is how quickly on the new tax brackets, we get to that 35% bracket. Before there was a little bit more in slightly some of those lower brackets. So that's what you're talking about, that broadening. That's a much bigger bracket. And so ultimately what this means for virtually everybody was that on average in any of those tax brackets, we saw the effective tax rate come down with the Tax Cuts and Jobs Act going into effect. And with those sunsetting, I mean, obviously the brackets have changed throughout, since 2018, we've had that the growth of the brackets just on an annual basis, but we do expect that we're going to see that return to the highest rate of 39.6, and you will get to those higher income brackets very quickly.
Yeah, we were talking before before we got started that the percentage of people who file a federal income tax return that don't pay federal tax, and is it 47%? So 47% of filers don't pay any federal income tax. Will that number shrink? Probably, right? So this is going to affect pretty much everyone except the lowest income earners. Now, if you're a W-2 earner and you're making $500,000, $600,000, $700,000 a year, you're really going to notice a big change. So one thing you're going to want to do is make sure that you make an adjustment to your withholding. Now, I don't know if this happens automatically at your place of employment. I suspect it probably doesn't, Shannon. It's probably something you would want to take a look at and look at your other sources of income, but make sure that you aren't under withholding on your W-2, because you might have a nasty surprise when you go to file your taxes. And then these look like the blended rates in 2017 versus 2018. So this would be your when you kind of blend all these tax rates together, taxes really did go down pretty much it did go down for everyone.
Yeah, and that's what you were seeing too, Jim, that lowest tax bracket, the bottom 50%, or that lowest bracket of income earners, their effective rate was only 3%. So,
right. And then the brackets throughout the years. And I got to tell you, on a high level, we're looking at a graph here. If you're watching this on, on video, taxes have been going up worldwide for about the last 5 years. And that's a trend. We have the baby boomers. I believe the last baby boomer will retire. I mean, retire. I'm going to put this in air quotes, hit retirement age, I think in 2033 or something like that. Mm-hmm. And that's a big slug of people that are leaving the workforce. The millennials are now the largest block of people in the workforce, but there will be fewer workers. And if there are fewer workers, that means less Social Security tax, arguably less income tax. The money's got to come from somewhere, and we can only print money for so long before we really have to address these issues. So I would say I'm preparing personally for higher income taxes over the next decade or 2 decades. And it's something that we just have to pay more attention to, because there are things you can do, as you will see in here. There are things that you can do to mitigate some of those taxes. So I would say consider tax planning in 2025 at the absolute latest, for income tax planning in 2026. If we are looking at a W-2 earners, again, look at the impact of the higher tax rates. You also need to look at your halving of the halving, the cutting in two, or the dividing by two of your standard deduction, and yet the return of the state and local tax full deduction, and your exposure to AMT, which is alternative minimum tax. I know it's a lot to throw at you if you're listening to this or watching it, but please pay attention to this. Certainly if you're in those higher levels of income, because you may have a very nasty surprise down the road, and you may have interest and penalties on top of that. And if you have employer-sponsored stock incentive plans, stock options, RSUs, whatever you've got, that's something you want to talk to Shannon, or somebody like Shannon, if you already have an advisor. Is talking to someone like Shannon, you can say, look, if we exercise this stock in this particular year, this is going to be the tax liability. What is your income going to be in 2024? What is your income going to be in 2025 and 26? We look at the tax rates, and that's something, Shannon, I know you work with clients on extensively, and
Yeah,
other
absolutely.
tax planning strategies.
The other thing that I would point out too is that, we're kind of really harping on that W-2 income earner, but even if you're a retiree that's got very large, IRA accounts that you're subject to those RMDs, those are taxable at ordinary income tax rates. So the tax on those is going to be impacted as well. So when I think about planning opportunities, I look at, are there ways, Jim, to your point, for us to kind of accelerate some income or realization of certain income into years when we expect the brackets to be lower? Or are there ways that we can push certain deductions out further into other tax years where they will be more valuable when they're deducting against income that's at a higher level? And
Yeah,
all
and
of these
go on, sorry.
decisions are so connected to each other, right? Because we're talking specifically about federal, but SALT rules aside, we also have to think about how each one of these decisions about doing a Roth conversion, for example, to accelerate income. How's that going to affect your state income taxes as well?
Yeah, I was just reading, if you buy a place, I think it's for $500,000 in Spain, you can kind of live there for a few years, you know, and hopefully, I didn't even look at whether, if you do a IRA or Roth conversion, if you have to pay Spanish income tax. I think you don't, but those are some kind of out of the box thinking, and most importantly, in a multi-year time horizon. I would say the single biggest, tax planning mistake that people make on a very high level is thinking about taxes year by year by year, rather than looking at what are my taxes going to be. Certainly if you have a retirement account like an IRA, what are my taxes going to be like for the next decade or 2 decades? And there are levers you can pull now to reduce your overall tax liability in the future. And I'll tell you, I'm really glad you mentioned RMDs, Shannon, because we have clients, and many times these are older clients and clients in their 80s. They have enormous IRAs, and their minimum distributions are equally enormous, right?
Yeah, absolutely.
Hundreds of thousands of dollars, multiples of hundreds of thousands of dollars, depending on the size of your IRA. If you pick well, right, if you picked NVIDIA 10 years ago or 5 years ago or 2 years ago, you may find that your IRA just mushrooms, and then those RMDs, they still have to come out because it's a percentage of the account.
Sure. And one of the things, just to kind of put a bow on income taxes, that we didn't really touch on is that the rules around charitable deductions are also set to sunset as well. And there's strategies that we can use to use some of your retirement assets to meet some of your charitable, goals. And so there's a lot of different strategies. And again, to Jim's point, we could talk until we're blue in the face about all the changes that are coming, but there's a lot of different levers to pull between now and then.
All right, so let's talk about the estate tax relief. So right now, as we speak today in 2024, each person has a $13.61 million estate tax exemption, meaning a person dies with an estate of $13,610,000. That goes to the kids, to the grandkids, goes to anyone. That goes free of tax, assuming no lifetime gifts. So if you make a gift of $1 million during your life, that kind of comes back, and that's subtracted from your 13.61 million. So that is getting cut to 7 million per person. So if you're sitting there listening to this and you go, oh, well, I've got a $15 million estate and I'm not married and I want to take advantage of this. Unfortunately, the rules, they kind of stink, for lack of a better description. And we'll get into how that works. But the tax rate's going from 40 to 45%. Now, that is a crazy amount of money. That is not just on the income. Think about this. This is on every dollar over $7 million, 45%. If you have a $17 million estate, $4.5 million is paid in tax. Now, if you're a person who doesn't have much, you go, well, that's okay because they still have a lot of money left. Let me tell you, people who pay this, they cry, they get emotional. It is painful to let this go. And for many people, somebody might have spent a whole lifetime accumulating this wealth. It's can be very traumatic. And Shannon, I have heard some smart people say death taxes are optional. And there's a large amount of truth to that. But let's talk about the structure. And I want you to think about death taxes, and I use the term death taxes because these are federal estate taxes, but death taxes are also some state death taxes in there. Now, California shockingly does not have a death tax, but Oregon and Nevada, or Oregon and Washington do, and some other states do as well. So in 2011, we received an expanded $5 million coupon that's adjusted for inflation, and now it's about $6.8 million. On top, so then that's the cake, and then that's the Obama cake, and on top of that cake, we got Trump frosting. So it is not, if you want to make a gift, you don't take a slice of cake and a little bit of frosting, a little bit of cake. When you make a gift, it goes from the frosting down, or goes from the cake up first. So when you make a gift, you are making it out of your Obama exemption first. That Trump exemption in 27, that Trump 2017 exemption is going away January 1, 2026. It's like it's getting wiped off the top of the cake. So if you want to utilize, this is very important, and please pay attention to this. If you want to utilize the extra $6 million or $7 million exemption that we got in 2017 during the Trump Tax Act, you have to make a gift of all of your Obama exemption first. So let me say that another way. If you want to use up or take advantage of this Trump gift exemption, you have to first make a gift of 6.8 million of assets, and then you're making a gift from the Trump frosting. So this is very, very hard for people who, a couple with a $20 million estate. It's very hard to do this type of planning. So we use one strategy in particular, or it's the first one we look at, is a spousal lifetime access trust. At least one person can burn, so the term we use, burn their $13 million exemption, and effectively pick up, save a few $1,000,000 in taxes for the family. But these are big decisions. Many people look at this and many people say, it's not for me. Now, a lot of people go ahead and do it, but bear in mind, if you're in that sort of $10 to $20 million space and you're married, this is way trickier, Shannon, and we've seen this. And if someone has a $100 million estate and they're single, it's kind of easier because, all right, you just make a gift of, 13 million, you still got 87 million left. So it's a little bit easier process. So that Trump cake is getting wiped off. Gifts have to be made first from your Obama exemption, the oldest exemption. Now, one other wrinkle on this is portability. So if you're a widow or a widower, meaning you've lost a spouse and you're a surviving spouse, this does not apply to registered domestic partners, by the way, only spouses. Portability allows you to pick up or inherit your deceased spouse's exemption. So when making gifts, and we're going to discuss what portability is. So you inherit your spouse's $13 million exemption. When you make gifts, it first comes from your deceased spouse's $13 million, then your Obama exemption, then your Trump exemption. So if you have filed for portability, right, and you want to make gifts, you might have to give a lot to pick up that extra Trump $7 million exemption that's going away. So I hope I didn't put too much on there, but understand and this has to be filed within 9 months or 5 years for a late filing. If you've lost a spouse and you're going to make gifts and you have not yet filed for portability, depending on what your trust says, there are some additional planning strategies. So if you know someone who's lost a spouse in the last 5 years, or it's you, this is something you really want to pay attention to. It's something we help clients with all the time. So an example, Abel and Baker are married. Abel dies June 19th, 2019. Okay. That's more than 5 years ago because we're recording this in July of 2024, when Abel and Baker's estate is valued at $5 million. Baker never files for portability. And Shannon, we see this a lot. They go to the advisor, Baker goes to the Baker's CPA and says, hey, Abel died. We have a $5 million estate. The CPA says, don't worry about it. You have an $11 million exemption. Don't worry. CPA is not thinking it's going to go away in 2026 and it's going to be cut down to 7. And it's only a $5 million estate. So there's no worry because, it won't get past 7 million. But what if Abel and Baker had NVIDIA stock. We used to say Apple stock. Now it's NVIDIA because it went up. It's sexier. And now the net worth is 30 million, right? So Abel and Baker's heirs are going to have to pay $5 million in federal tax because Baker did not file for portability. And now it's too late because it's been more than 5 years. Let's look at Charlie and Delta. Same facts. Charlie dies on August 19th, 2019, when Charlie and Delta's estate is valued at $5 million. Actually, so August 19th, which we're in July of 2024, 5 years hasn't happened, right? So Delta's going to run down to the attorney's office, CPA's office, get that Form 706, which is the death tax return, get that filed, pick up the extra $11.4 million death tax exemption. This saves $5 million in death taxes. So here's the upshot. Pay attention to portability. Portability is where you file a return, and as the surviving spouse, you pick up something called the deceased spouse's unused exemption. If you've lost a spouse within the last 5 years and have not paid attention to this, you really need to pay attention to it. If you don't have an advisor on this, please reach out to us. If you have a lawyer, CPA on this, talk to that person. And if I will tell you, Shannon, when people say, "Oh yeah, don't worry about it," I always get that makes me a little nervous.
That's a red flag.
It's a red flag because you don't know what investment's going to take off. And we're at an inflection point. We're in technological advance with AI coming out. A lot of these companies are just going to take off and explode in value, and you just maybe pick the right one. But I think it's increasingly difficult to predict what the size of your estate will be given these changes that we're looking at. So, top strategies: assembling your A team. Shannon, you are one of the legs of the three-legged stool. I'm one as well, and the CPA or the tax advisor. So, look at filing for portability. We're going to talk about a dynasty trust. We see those a lot. People ask about those all the time. Spousal lifetime access trust. We'll talk about that. That's where you make a gift to your spouse. Discounted valuation, irrevocable life insurance trust, and Roth conversion. So just to clear the air, if you are a resident of a community property state, well, if you're a California resident, everything that you own under current law, when you die, that everything that you own that's community property gets an adjusted cost basis. This is not automatic. Assets must be valued. You have to take some steps. You have to have the proper documentation. But I would say many of our clients, the surviving spouse essentially inherits all the assets, files for portability, picks up the extra $13.61 million in 2024. And I would say the two biggest mistakes that we see in the real world are failing to get your appraisals, right? Or failing to pay attention, and then also failing to file for portability. And Shannon, I want you to talk about, if I own individual stocks, my spouse passes away, that's community property. What should the advisor be doing on the account level with those stocks?
Absolutely. So you're entitled to what's called a step up in cost basis in that situation, right? So if that stock is now worth $5 million and it was purchased for $1 million, that difference, that $4 million, while the first spouse is still alive, and if any of that stock would be sold, that $4 million is subject to capital gains taxes. What happens when that first spouse passes, because the assets are community property, is it's now worth $5 million. That cost basis is now stepped up or adjusted to be equivalent to the current market value at the date of the spouse's passing. So $5 million. So surviving spouse could then make the decision, hey, I'd like to sell some of this stock, diversify, and they are no longer subject to those capital gains taxes. And we see it a lot where it's missed. We'll be speaking with a widow, for example, and looking at her accounts that have, cost basis from years before her husband passed, that, the advisor just never stepped up the basis and potentially subjected her to unnecessary capital gains.
Yeah. I mean, I would say this is why I put in here failure to appraise the property, failure to properly document the change in basis on your income tax return. This also applies to rental property. So my parents have a lot of rentals, and they moved to Texas, which is still a community property state. So when one of my parents passes away, the other one will get an adjusted cost basis. You need to reflect that in your income tax return and change those numbers to start redepreciating the property. So the other thing I want to mention about community property is a lot of people, and we just had a webinar not too long ago on this, a lot of people move to California to retire. And I know if you're living in California, you're like, wait, what? People move to California? Yes, they do. A lot of people leave California. So a lot of people coming, a lot of people going. Colorado, for example, is not a community property state. So if you're a California resident and you have this brokerage account and you move to Colorado, you may lose this benefit. Now, there are some workarounds. There's some other jurisdictions where you can essentially manufacture a community property trust. And we've covered that in other webinars, but this is very important. So when you choose to retire, moving out of a community property state into a marital property state, you do not get this benefit, and you only get a half adjusted cost basis. You're only getting half the benefit. So how does a dynasty trust work? So a dynasty trust is essentially like a treasure box that is passed from one generation to the next. So once a person puts assets into this treasure chest, if you will, it is outside of the person who made that gift. It's outside of that person's estate. It is also, this is what makes it a dynasty trust. It is outside the estates of the people who get the benefit of this trust. So I create a trust. I set up a dynasty trust for my 3 children. I put in $13 million. That is not in my estate. That is not my money. It's gone. I can't have any of it. That is for my 3 kids. And to the extent they don't use it and they all die, it goes to the grandkids outside of the estates of my children. And this is really important, Shannon, as we've seen, because we have many clients with legacy. We have one client in particular, trust is almost 100 years old. And we're going to talk about that in one of the Biden proposals. Trust is almost 100 years old. It has a lot of money in it because it's been growing over time. It's growing for almost 100 years. So these assets can become quite significant and avoid that 45% haircut as people die. So remember, if you don't do this, and you have a taxable estate, so 45% of that 13 million goes in tax. And then as your kids die, 45% of that potentially goes in tax as well. So it really gets a haircut. By the way, the stated reason for the death tax in the United States, the estate tax, is to redistribute wealth. That is the reason the estate tax exists. It's to take it from wealthy dead people and redistribute it to the rest of the people in the United States through taxation. That is the stated purpose. Let's talk about an ILIT, so irrevocable life insurance trust. So life insurance passes income tax free, but if I have a policy of life insurance in my name and I die, it's included in my estate. So Shannon, how does a life insurance trust work? And just kind of walk us through the mechanics. So the idea is you have like a $10 million policy, you want that outside of the estate, you're saving $4.5 million in tax. Unpack this for us.
Sure, absolutely. So the trust is formed, the Irrevocable Life Insurance Trust, ILIT, and as the as you, the person who's trying to avoid this estate tax, it's really important that you want to make sure that you do not have what's called an incidence of ownership. So you should not be the trustee of this life insurance or this trust. Oftentimes what we've seen in the past is that someone will, want to name a sister or a brother, for example, as the trustee of their life insurance trust. And I think sometimes people don't realize that, while that's an honor, it's also a duty. So there's also the ability to have what's called a corporate trustee come in and act as the trustee of that trust for you to handle some of the intricate requirements of a life insurance trust, some of the notifications that need to be sent out every year, for example. But ultimately, at a very high level, how that works is the life insurance policy is purchased inside the trust. You gift into the trust so that the trust can pay the premiums on the life insurance. That the benefits of the life insurance policy at your passing remain outside of your estate. You also have the added benefit of any of the money that you use to pay the premiums that goes into that trust. That's also additional funds that are coming out of your estate. And then the benefit of that, the death benefit on that life insurance policy after passing, would then go to the beneficiaries of the trust, which can be kids, can be grandkids. Where we see this used a lot also, let's think about Jim's example of that taxable $10 million estate, 4.5 due in taxes. Well, what are your heirs supposed to do if that $10 million is mostly the value of a business or mostly real estate, and they don't necessarily want to sell that business or sell the real estate? Being able to have a life insurance policy that could potentially create some liquidity for them to pay any estate taxes is also another reason we'd want to evaluate an ILIT.
Yeah, and what this does is this, again, it provides liquidity at the time that the taxes are due, because the idea is life insurance pays out when you die. The taxes are due 9 months after death. This provides a pot of cash that you work with your living trust and the ILIT to supply cash. Typically, it's a sale of assets from the living trust to the ILIT, the life insurance trust. That infuses cash into the revocable trust that allows you to pay the tax. That's kind of the mechanics that happens on the back end. And this is a very powerful strategy. I will tell you, many people say, hey, this is great. sounds great. A lot of people say, oh, life insurance, it's a big scam. It's a ripoff. I will tell you, the people who are convinced that it doesn't work, when you look at the mechanics of it, they go, oh, I see why it works. Now, is this because the life insurance industry is a very powerful lobby with the state and federal governments? I'm not going to comment on that, but they do have a lot of money. Spousal lifetime access trust is an irrevocable trust that allows me to give to my wife 13.61 million, not paying any gift tax. That is for my wife. She will be very happy. I can have no role in the trust. I can't be trustee. I can't be beneficiary. That money can't come back to me. I can't say who gets it when I die, right? So Abel and Baker are married. Abel and Baker create a separate property agreement. This is important if you're in California or a community property state. You have to create a postnuptial agreement that says, this is my separate property. So my wife would have to give me, right, her half of that 13.61 million. And then I create this trust for my wife. So in this case, Abel creates a spousal lifetime access trust for the benefit of Baker and their kids, Charlie, Delta, and Echo, funding the spousal lifetime access trust with Abel's separate property. Abel can't serve as trustee or be beneficiary. And then, how does Abel get the money back? Well, I guess Abel has to be really nice to Baker, right? That's kind of how that works. But that is, it's a done deal. You have to be aware of the reciprocal trust doctrine. And what is that? That's if Abel does one for Baker and Baker does one for Abel, and they're the same terms of the trust, same lawyer, same day. That's a problem. That's a reciprocal trust doctrine. The IRS says, nice try, but you can't do that. And they ignore those trusts. So these have to be very carefully drafted. And that's certainly a one-on-one conversation. What about businesses and the 2017 Tax Cuts and Jobs Act? So one thing was that 35% tax rate went down to 21, which happens to be the Laffer curve number, who was an economist under the Reagan administration. That is the optimal amount to tax of like GDP, right, to balance economic growth and paying for government. So it's kind of interesting that it's a coincidence. And this is permanent. So this is the one thing that was permanent with the Tax Cuts and Jobs Act, is this reduction to 21%. And the other one is qualified business income deduction. Do you want to talk about that, Shannon?
Yeah. So right now, if you are, not a W-2, but you are a business owner and you're structured as a partnership, an S corp, or a sole prop, any of those you're not a C corp, for example, you're currently able under the Tax Cuts and Jobs Act to take a deduction of up to 20% of that business income on your taxes. And so that is a major change that is looking to go away at the end of 2025. So that's another planning opportunity, is to look at, are there ways that we can kind of maximize our use of this QBI deduction before it goes away at the end of 2025? I think it's also going to spur a lot of conversations with, tax planning partners like CPAs and advisors like myself about, hey, is an S corp or a partnership the right structure for me? Should we be a C corp? And there are so many different intricacies that go into those decisions. So it's time to start making that evaluation.
So, you may be asking yourself, why did business owners get this deduction? Typically S corps, partnerships, those are typically smaller companies, Apple, Nvidia, those are C corps, right? Those are big corporations. But I think the purpose of that was to really encourage people to start a business and to continue with the business, and not just, fold up their tent and go to work for somebody. It's to take that risk and be the entrepreneur. And getting that deduction really was designed, I think, to reward that and to encourage that activity. So Hal, the plumbing contractor, and this is a concrete example, earns $1 million a year, and he can deduct 20% of his income. So that's a $200,000 deduction. It's not a credit. So instead of paying federal tax on the full million, he's paying tax on the 800. This saves $74,000 in income tax. That's a lot of money. Unfortunately, Wanda, physician, earns $364,200. She can deduct 20%, saving $17,000. But if it's over $464,000, there's no deduction. So if you're a lawyer, if you're a healthcare professional, accounting, actuarial science, performing arts, consulting, athletics, financial services, and you're like, well, I'm not getting this. Yeah, you're not getting it because you're making too much money and you can't get it based on what you do. Bonus depreciation allowed 100% bonus depreciation from 2017 to 2023. This is getting phased out, and typically this comes in at the end of the year, and they have kind of brought back this bonus depreciation. So the idea is if you buy a $5 million piece of equipment, you know, a bulldozer for $5 million, and you're in the business of bulldozing stuff, you can take an income tax deduction in the first year of 5 million. Otherwise, you're taking it over 5 years or some other longer period. And this permitted this sort of bonus depreciation. I think this started in 2001 or 2002, and it's been continued for many years, but it's, you know, it's been phased out. So I'm not sure that's going to, I don't know if that's going to be coming back or not. I don't know what your tea leaves are showing you, Shannon, but I haven't seen a lot of discussion about that.
Yeah, I think that that's one of the ones that, much like you were saying about, well, why is this in the tax code, to QBI, for example, to spur entrepreneurship? Well, for me, this is in the tax code to spur that investment. And, it seems like every election cycle, we hear a lot about job creation. And I think this is one of those things, is encouraging the investment back into the business to build the infrastructure to support further employment. So, I think this is always going to be a talking point in the future, but as we can see, it's already phasing out right now and set to continue to do so.
Yeah, and another way of looking at this, just from an operational standpoint of business, if you're going to buy a piece of equipment for $5 million and you have 5 million, you can buy that. If you take your income tax deduction, you're not, you're saving 2.5 million in tax. Okay, I'll buy that piece of equipment without debt. If you're taking your depreciation over a longer period of time, you may put debt on that equipment, right? Because you don't want to write a check for 5 million, but only get a deduction for $1 million or 2 million, and you still have to pay tax on that other amount. So I think there may be some banking forces that are out there that are encouraging this, I don't know, non-renewal of the 100% bonus depreciation. I'm not getting into conspiracy theory, but I'm just saying, as a business owner, these are real decisions that you make, because you have to pay your tax every year. And if you don't get that deduction for the equipment, many people do take on debt to match up the depreciation with the debt service. And that helps you just from a cash flow. So if you're a business owner, you're like, wow, I didn't really even think about it that way. This is why it's good to have your CPA, financial advisor, and lawyer on the team, because these are things we go through with clients. It's like, should I pay cash for it? Should I take on debt? How much debt should I take on? A lot of people are adverse to debt. Employee credit for paid leave, tax credit for businesses for paid family leave. Is that going away?
Mm-hmm. Credit's ending. Yep.
Credit's ending. Non-corporate taxpayers usually deduct business losses, and these are a little bit of change there. Do you know?
Yeah, right now, with
that?
Tax Cuts and Jobs Act, the limit on there is a limit on losses for non-corporate taxpayers, and it's set out into the future to have larger losses be able to be deductible. So this is actually a good thing.
Opportunity zones. These are kind of ending largely, with one huge exception. I don't know if we want to spend much time covering these, other than
it's just a way to defer taxes at the federal level. And if that's a problem that you've got, let us know.
So how can you prepare? Look at asset purchases and considering accelerating that asset purchase if it makes financial sense. Consult with your tax professional. All right. What is the optimal timing for acquiring assets to maximize these deductions before they expire? Are you going to be in line at the Ford dealership or the Chevy dealership on December 31 at 9 p.m. getting that piece of equipment? If you know what I'm talking about, if you drive by any truck dealer on December 31, there's a line, trust me. What are alternative depreciation options, such as Section 179 deductions? Do you want to talk about that?
I'm not familiar.
Section 179 is bonus depreciation, expensing that business property all in 1 year or a shorter period of time. I believe it's 60% bonus depreciation this year. And estate planning strategies to offset estate and death taxes. So portability, irrevocable trusts, discounted valuations, which we've covered in other webinars. Roth conversions, which we have covered in other webinars, not so much here, but that's where you take your IRA, you pay the tax now, not the tax later. So stay informed, get your A-team. Let's end with the estate tax changes in the Biden 2025 budget. Now, this is nonpartisan. What we're talking about here is, what are the estate tax changes in the Biden 2025 budget? These are proposals. Some of these have been around since the Obama administration, okay? So these are things that keep popping up where certain lawmakers say we need to make these particular changes. So this would increase taxes by 4.4 trillion, but after tax credits, it nets out at 3.4 trillion. What's that 1 trillion in tax credits? It is the government incentivizing people to spend money in a certain way through tax credits, meaning if I invest $1 million in commercial solar, I'm going to be able to offset $400,000 in my federal income tax, plus depreciation on top of that. But you get a little bit of a haircut if you have a tax credit. So that's what that means. So that what the government is doing, the government wants to build out renewable energy. That is not going to build itself. The government is not going to build the solar panel arrays. They are going to give people tax credits so that they build those installations. You see where I'm going with that? So the government encourages people to engage in certain activity when it doesn't want to do it, when the government doesn't want to do it on its own. So higher top tax rates on investment, savings, and work. In the long run, this is the tax foundation. In the long run, it reduces economic output by 2.2%. Wages are down 1.6%, and employment is up by 788,000 full-time equivalent jobs. I am reporting what someone else is saying. This tends to be a more conservative think tank, but understand that this is what the analysis of the proposal. So on a very high level, there's more tax on high income earners, more tax on U.S. businesses, and more tax credits, again, for a variety of taxpayers and activities that the government wants taxpayers to engage in. The U.S. tax code under this budget plan would become more complex, less transparent, and focuses on desired social outcomes through tax policy. So social outcome being we need more renewable energy. That's deemed a social good with many lawmakers, and they do that through the tax credits. This would make the top tax brackets among the highest in the developed world. I just went on vacation in a foreign country that traditionally has had higher taxes, and California's taxes are higher than that country, and we don't get healthcare included. So go figure. The Biden budget contains new and radical proposed changes to the tax laws when it comes to trusts and estates. And so let's look at some of them. Right now, Shannon, I can give my kids that appreciated NVIDIA stock and there's no realization of capital gain. So if I paid $1 for it and it's worth $10, there's no capital gain. Under this proposal, when you make a transfer, you have to realize a capital gain, okay? So that tax would have to be paid. Capital gains tax rate going from 20% to 39.6% on income over $1 million. And you may think, well, gee, if someone makes $1 million, they should be paying that. Well, what if you're selling that stock portfolio, or that you spent a lifetime creating, or you're selling that piece of property, right? That real estate for $10 million that you paid $1 million for, and that's your retirement. Well, you're going to have to pay capital gains tax, state and federal. You might have to pay 50% in tax between California and federal with these numbers. Assets in trusts or partnerships marked to market. What that means is kind of deeming it to be a sale every 90 years. So if somebody's had a trust, the Kennedys who did their trust in the 30s, I think, those assets would be marked to market, and that a tax would be paid. And so the first tax would be December 31 of 2033. Again, you might say, well, these people are rich. They ought to be paying it. And this is really a political question. If this is you, then, cast your vote a certain way. And if you think this is wrong, then cast your vote a different way. So no discount for partial interest. This is very, very important. Right now, if I give you a pen, right? If I give you these glasses and I say, Shannon, you can't sell them and you can't use them, it's not worth, if these glasses are $10, it's not worth $10, it's worth something less. So what they're doing is taking that discount away. And we covered this in other webinars. And if you don't quite grasp this, just understand that people are able to give away about $20 million in assets and only be taxed as if it's $13 million. The government really wants to throttle that back and limit it just to active businesses. So this would take away many real estate and other passive business activity. Transfers to and from a trust other than your living trust, right? So we do a lot of irrevocable trust planning in our firm, or a partnership would be a recognition event. So if you put property into an LLC, for example, you might have to pay capital gains tax. So transfers to a U.S. spouse would not be realization events, but would receive a carryover basis. So what does this mean? Well, we've talked before about if you have community property and one spouse dies, you get a full adjusted cost basis. That goes away, right? So You're losing your adjusted cost basis. Top income tax rate goes to 39.6%. That's going to happen with the sunsetting of the Tax Cuts and Jobs Act anyway, and transfers to a split interest gift, which is a charitable trust, basically where you say, look, I'm going to put some money in a trust, and the charity's going to get, when the trust ends, the charity's going to get some, and I'm going to get some income along the way. It's called a split interest gift. What their proposal is to eliminate the charitable, only allow that portion that goes to charity, right, to avoid the tax, and amounts that come back to you, you would have to pay tax on at that point. I think this would really eliminate the use of charitable trusts as a planning strategy for deferral of income. So let me give you an example. I'm selling a building for 10 million. I don't want to take that 10 million all in one year. I'd like to spread it out over 20 years. I can do a trust that says, pay me the income for maybe 5% a year for 20 years, which is 100%, right? Pay me 5% a year for 20 years. And when that 20 years is up, the remainder goes to charity. That would be an example of deferring the gain over a longer period of time. I would only pay tax as I receive those payments over that 20-year period. What this proposal would mean is that you would have to front load all those taxes in that first year. So I think it would really curtail the use of charitable trusts. The $5 million exemption, again, this is part of the 2026 sunset, goes down to $7 million, and it's going to be scheduled to happen in 2026 anyway. Portability still remains between spouses, so that's good. And then a minimum tax of 25% on total income, including unrealized capital gains on taxpayers with wealth over 100 million. We were talking before this, Shannon. I'm not sure this is constitutional, but it might be if if it's the income from these assets. So I think clearly, we have the 17th Amendment, which permits the taxation of income, and the government, I think, has broad discretion to calculate how to tax that income. And then there's some proposal about, you can spread the tax over 9 years. So if you have a net worth of over 100 million, you might want to pay attention to this. Again, if you're the kind of person who says, hey, if a person has 100 million in net worth, maybe they should be paying it. Again, that may drive how you cast your vote. A GRAT, which is a grantor retained annuity trust, currently has a minimum term of 2 years. That's a very popular tax planning strategy for a wealth transfer strategy. And this would make that minimum term be 10 years, which kind of blows the planning out, kind of eliminates the planning, frankly, to a large extent. And then sales between intentionally defective grantor trusts. Again, we cover these in other webinars. So what this is a lot of wealthier people use this trust strategy where you make a gift of property so you don't own it anymore. You're still responsible for the income tax, and that payment of income tax, right? So you've given 10 million bucks to your kids, and you're generating 100,000 a year income tax liability. Well, you still pay that income tax liability. That is not an additional gift, at least under current law. And this proposal would seek to unwind that, and also have you realize capital gain when you make a contribution of assets. So again, I think it would really strip the utility, broadly speaking, for many of these trust strategies that many of our clients use. And then intrafamily transfers, eliminating discounts for lack of marketability and control. The idea is if I give you, Shannon, these glasses and say, I'm putting restrictions on it, there's a way you can compress the value pretty much from about 20 million down to 13 million. You can compress that value. That would be eliminated under this proposal. And then it caps total gifts at 50,000. Right now, as we know, Shannon, we can give 18,000 per person per year. If you have 10 people, you can give 180,000. This proposal would cap it at 50. And then the generation skipping transfer tax exemptions, getting a little technical. And I think it would compromise the utility of the dynasty trust that we talked about. So this is that lockbox that goes from generation, generation, and generation. And all of these are designed to generate more revenue. All of these are designed to tax multi-generational wealth. And so if this is you and you go, hey, I don't like this, I want to do something about it, I want to get some of these strategies in place before the effective date, if this ever happens in the future. Again, it's been around since the Obama administration, but these are things that are kind of hard to follow and esoteric that the tax geeks know about. And if you get one party in power or the other party in power, you may find these implemented and it's too late to do anything about it, right? So it's very, very important to, if this is of an interest to you, if you've heard about this, you've been kind of thinking about it for a while, you really should be moving on this pretty quick, because these could simply just go away. So we have offices throughout Northern and Southern California. And here's our contact information if you'd like to reach out to Shannon or her team, 805-312-7200, or you can reach us toll free at 866-988-3956, and we'll put this back up. If you're watching this on YouTube, please subscribe to our YouTube channel. Next up, next week is California Probate, Cost, Navigation, and Probate Alternatives. So there's actually a lot going on in the probate space and the California State Legislature right now, and we'll be covering some of that. So very important to understand that probate process. And as we've seen, Shannon, many people who have a living trust, their families still end up in probate court because sometimes it's not properly funded. So we will open it up for questions. And if you're watching this on YouTube, just keep watching because we're going to have another video roll right up after this one. So thanks for watching.